In finance, three questions are very important. These questions are: what are the sources of the funds? What will be the uses of the funds? And how the return will be distributed among different stakeholders. In today's video, I will talk about the sources of the funds, that is capital structure. If we define capital structure, the mix of firms' financing arrangements represented by debt, equity and preferred stocks. Debt is the borrowed capital that includes debentures, loans from the banks or financial institutions. And equity includes reserves and surplus and issued capital. And the preferred stocks are hybrid securities, including features of debt and equity. The capital structure plays a very important role in the firm's financing decisions. It can increase or decrease the cost of capital that helps us in deciding about investment opportunities. Normally, capital structure is applied to permanent or long-run capital that undergirds a company's operations. The basic motive of finance is to maximize the wealth of the shareholders, and this prime objective can be achieved if financial managers set an optimal capital structure for the company. Planning a capital structure is a highly psychological, complex and qualitative process. Each of the components of the capital, debt, equity and preferred stock has its own benefits as well as costs associated with each component. So that's why it's a very difficult, complex process to decide that what will be the level of debt or equity or preferred stock in the capital structure. Normally, it involves the balancing the shareholders' expectation, risk and return, as well as the capital requirements of the firms. While deciding about the capital structure, there are few considerations that financial managers should consider. The first one is return. The capital should have the ability to generate maximum returns to the shareholders. That will maximize earning per share and market price per share. The second important consideration is cost. A capital structure should minimize the cost of capital, that is weighted average cost of capital. That is cheaper than equity due to tax shield. But on the other side, high level of debt increases the cost of equity as well. So that's why deciding about the debt is a critical step in capital structure. Risk involved in solvency risk is also associated with the capital structure. If a financial manager increase the level of debt, then the firm's risk will also increase. It will reduce cost, but on the other side, it increases the risk of the company. So that's why, while deciding the capital structure, this should be an important consideration. Financial managers should consider the level of risk as well as return from each component. Control is also important from the owner's perspective. If firms share equity capital, then there will be dilution of the management control. That's why the owners prefer debt or preferred stock. A capital should be flexible, altering capital structure without much cost and delays to raise funds whenever required. And lastly, capacity. It should have the ability to generate profit, to pay interest as well as principals. These are some important considerations that should be considered while deciding about the capital structure. While studying about capital structure, two questions are very important and frequently asked. These are: does capital structure matter? Can the total market value of the firm's security be increased or decreased by changing the mix of debt and equity financing? The other is, if the capital structure does matter, what factor determine optimal mix of debt and equity that will maximize the firm's market value and thus minimize its cost of capital? In the next videos, I will try to answer these questions. If you have any questions or confusions related to finance, you can contact us. We will try to provide you best answers. Thank you. Take care. Allah Hafiz.